Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Jim Dalton. Remember, new shows are posted every Monday and Thursday. You can subscribe to our show on iTunes and YouTube. If you're enjoying the show, please leave us a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Now, today on the show, I had Jim Dalton. He's the author of Markets in Profile and Mind Over Markets, and he's the general partner at Jim Dalton Trading. The topics that Jim and I discussed today were Jim's backstory and how he got started in trading over 40 years ago. He tells us why his favorite tool is Market Profile and how it gives him an edge in his trading. Jim shares with us how he prepares to trade each day and his process for entering and exiting trades. Last but not least, we talked about Jim's trading diary, trading psychology, and immersion training. As usual, thank you all for listening, and please enjoy this episode. Jim, welcome to the show.
Thank you.
Very excited to have you on the show today, Jim. Thank you so much for joining me today. I've been really looking forward to this interview. You've been in the futures industry for over 40 years. You, like myself, started on the trading floor, so I'm very interested to hear how you got your start in trading. You've written a couple books that have been talked about a lot on this show and with a lot of traders that I know in the industry, Mind Over Markets and Markets in Profile. So curious to hear a little bit about those books and, of course, about your trading process, because I know that you are still trading. So all of this is interesting to me, Jim, but take us back to the beginning a little bit. I'm very curious. How did you get your start in trading?
Well, I came out of the brokerage industry, and it wasn't something that really appealed to me very much as a customer's man. And I came up to Chicago many years ago with a firm that was called Payne Weber at that time. It's now UBS. And their offices were in the Chicago Board of Trade building. And at that time, it was just prior to the formation of the Chicago Board Options Exchange. I had worked in options for some period of time in the over-the-counter market, and they were going to let me hold their first seat that they bought on the options exchange. So I became a holder. He bought the Board of Trade seat. And then the Board of Trade seat had with it a right to have the options exchange seat. So I held both in those days. But my focus was really on the options exchange because that was what is new, and that's where my experience was. So I chuckle. I didn't do a lot of trading on the floor. I was a floor official at one time, which I chuckled at. But I basically worked upstairs, and then I worked in the options area, also ran an institutional trading desk for a period of time. And so that the institutional trading desk is really what kind of got me interested in trading per se. And then I had the seat on the options exchange, and I was going to go down and work on the floor. And then Payne Weber took me back to New York to run the options department for the firm, which was a big undertaking at that time, and of course that grew to be a substantial a piece of business. As I've retired from what's now UBS 4 times, and each time I retired, I did something else. But when I retired the first time, I started doing individual trading, and I liked it. I enjoyed it. It was very exciting to me. But then, they asked me if I would come back, and I did that 3 times until retired. What I thought was the final time, and then my wife passed away suddenly, and they asked me if I wanted to come back again. And at that time, the undertaking they were getting some fairly large lawsuits in the hedge fund area. And they asked me if I would come back and see if I could straighten that out and get rid of some of that liability. Well, that put me in a whole new world. That had me introducing myself to hedge funds, accepting and rejecting hedge funds into our system where brokers could provide money. But that was a totally different experience when you come to trading, when you start working with the hedge funds and you see so many different strategies that were employed. So by this time, I was pretty well hooked on trading. So when I retired again, I was trading quite a bit for myself. As you said, I've written a couple books, Mind Over Markets and Markets in Profile. And then I really got interested in teaching traders. And I felt that there was not a real in-depth appreciation and understanding of what traders really dealt with. And I knew that the majority of individual traders had a terrible record out there. So like anything else, I started teaching trading. Early on, so much of it was kind of linear. And then I found out that the problem with linear teaching was that it didn't introduce traders to the intricacies and particularly the nuances of trading. So as time has gone on, we've gotten less and less linear based and more involved in immersion trading, where we're teaching people what's going on in the market at the current time. So my trading has evolved considerably from when I first was introduced to trading on the Board of Trade / Chicago Board Options Exchange, running an institutional trading desk, which of course is quite a bit different. And the trading, as I taught the trading, each question you're asked sends you a little deeper into understanding what's going on the other side of these, particularly the retail traders. So I just kept evolving in the market and going deeper and deeper into what really drives the markets.
Thanks for sharing that with us, Jim. Now I want to talk about market profile. As we mentioned, you wrote a book called Markets in Profile. I know that market profile is your favorite tool to use when you're trading. So when did you start to learn about market profile, and why is this one of your favorite tools?
Well, I started to learn about it just around the time that the Chicago Board of Trade was opening. I was looking at ways to hedge option strategies, and in doing that, I had some distribution charts on my desk, and they had different lines looking for where you might go long, where you might go short, where you might hedge them. And a friend of mine on the Board of Trade walked up and he said, you must be doing the same thing Peter Stottlemyre is doing. I said, I don't know Peter Stottlemyre. So Norman brought Peter up to my office a few days later, and as we were talking, I realized what Peter had discovered. Peter was a statistics major from Stanford, and he knew at that time that electronic trading was probably going to be the thing of the future. And at that point in time, the advantage on the floor came so much from sound, hearing the sound with voices and the noise going up or down. If you took out yesterday's high and the volume increased, then that new high was bringing in a larger flow of orders from outside the market. If it died off and got quiet, then you knew that the outside flow of orders was slowing down. And as a trader, you started to fade the market or go short against the rise. And he was realizing that that advantage was going to go away to the floor. So he was trying to look for some replacement for that. And what he realized is that you need to form a distribution curve. You need a constant and a variable. The breakthrough he made was recognizing that time was a constant. The time between 7 and 7:30 is the same between 8 and 8:30. Monday's as long as Tuesday, etc. So he put time, the constant on the horizontal line, price, the variable on the vertical line, and that formed a distribution curve, or what now is known as the market profile. When Peter wasn't in more than a couple of minutes, and when I realized the power of the constant, time the constant, I knew that I had to go and look more seriously into this. Peter left the office. He walked down to the elevator, turned around, he came back in. He said, "You want to sponsor my first book?" I said, "How much?" He said, $10,000. I wrote him a check out on the spot and became a sponsor of his first book, Markets and Market Logic. You look across the bottom of the front cover, and it said sponsored by J.F. Dalton Associates. So I recognized the value of what it did. I didn't realize the depth of it for some period of time. So I started taking classes from Peter, and you know how you learn something, and you think you have these aha moments, and you find out that, you know, as you get more experience, they're not really aha moments. The aha moments, as you get more experience, are when the nuances appear. And you find out that is really what makes the difference. As you well know, the competition is so fierce. You have to really have a level of understanding that is quite high, and that really comes with the nuances. So that was really, you know, my entree into the market profile. And up until that time, that what trading I did was kind of all over the lot. You know, I remember the first time I went down to the port of trade, one of the old timers put his arm around me and he said, "You know, most of us old timers as professionals, we fade the market." And I've always chuckled and said, that's probably the worst advice I've ever had from anybody. And I noticed today there's still a lot of people teaching courses to short-term traders, telling them that fading a market is the way to go. You'll find that is bad advice. When a market gaps higher or lower, and we only look at gaps if they're above or below the previous day's range, we want to see that there's really something has changed in the market. When a market gaps higher or lower, that's usually a sign or an indication of change. And when that happens, you want to most times be on the right side of that change. Sometimes the market, you know, won't follow through, but more often than not, it does.
First off, thank you for sharing that story about Stottlemyre in the book. That was pretty cool. What I want to know is, what is it about market profile that you believe gives you an edge when trading the markets over using other tools?
That's a great question. As you know, they say a trader without an edge isn't going to make a profit. The market, as I said earlier, is a continuous two-way auction process. But how do you organize that? And I think by putting it under the profile, it gives you an ability to look at the structure of the market. You know, if the market is going higher, for example, and, you know, it's really truncated, well, that's a pretty good sign that, yes, it's going higher, but higher prices are not really attracting, you know, more business from the outside. If that market goes too high, too far, too fast, then that's probably an indication that there's too much emotion involved in the market, and that's not going to have staying power. When you get a distribution curve and you see that it's got some symmetry to it, the way it trades, and I'm not talking about symmetry in a bell-shaped curve. There's just some order in which it goes up or down, and it's not too elongated, but it's elongated enough to say you're getting a continual flow of new business coming into the market. And it takes that in order to carry these markets higher. I'm not a profile trader. I only use the profile to organize the market's continuous two-way auction process. But I think that ability to organize the market is just a huge edge. As I say to people, making it really simple, if I had 50 people in my backyard for a barbecue and somebody came in and said, "Hey, Jim, what's the average height of these folks back here?" I have no idea. So what would I do? I'd go out and I'd organize them, tallest ones in the middle and taper it off to the shorter ones were on the outside. I'd now have a distribution curve, right? And I look at that curve. I say, it looks to me like probably about 5'9". And so by organizing the data, I think it gives me an advantage over most others. Working with unorganized data versus working with organized data, I just think that's a very powerful edge when you start to learn to trade. Now, learning to interpret that data, that's quite that takes some time in and of itself. It's not something that just is there immediately. You have to spend time with it. You have to be able to understand, is this, like I said before, new business or old business? New business that the market was going up would be, new outside flow of orders coming in. Old business at the market going up would be a short covering rally. And short covering rallies can actually weaken a market because they remove that potential buying power from the market. So it's important to be able to understand what kind of business you're dealing with in the market, who's doing it, why are they doing it, what's the motivation behind it. And I think the organization of that data under the market profile helps me with that understanding.
Okay, so you say your favorite tool is market profile, but then you say you're not a market profile trader. So what other tools are you using then?
I don't use any other tools. I don't use fundamentals. I don't use other technical tools, and I don't trade in a vacuum. And I understand that there are times when a market is going up and the traders are following a trend line. And that can become very obvious, but I'm not a trend line trader per se, but I'm aware of what the traders are doing. Now, when a market comes to a trend line, I may use the trend line and say, if a market is, let's say it's coming up to a trend line from below. If it's coming up from below to that trend line, and it's coming up on light volume and poor structure as identified by the market profile, then the odds of going through that trend line are fairly low. If it comes up to that trend line and we've got good structure, meaning it's healthy looking, we've got good increasing volume, then the odds are pretty good that we're going to go through that trend line. So I think that you can still use the concepts behind how I trade using market profile to increase your ability to use some of the technical indicators. But it's not a pure sense. And I freely tell people, don't fight momentum trading, for example. Momentum trading with RSIs and things like that, it's the most common type of trading out there. And the reason for that is it's the easiest to do. And if you go fighting that, then I think you're going to commit suicide. But being aware of that it's momentum traders, and you can start to see that in the market. You don't see it all the time at first, but over a period of days, you become aware that it's fairly momentum based. And momentum based is a lot of times it's more non-thinking. And it's just the momentum, the enthusiasm that goes. And when that runs its course, be very careful. And so I think that I'm not unaware of technical indicators and technical work. I use them as awareness. For example, like I said, I'm very much aware of momentum trading. I'm very much aware of trend lines, but I'm not trading them per se.
So what you're looking at is a trend of the market, momentum of the market, and market profile is a tool that you use to help you with execution of that trend?
I don't fight the trend. I look to see is the trend aging. When I see, for example, that the volume is starting to drop off, the shape of the profile is starting to deteriorate, and other words, it's losing some of its elongation, then I know we're getting pretty old in the trend. Doesn't mean the trend is over, but I know we're getting far along. And then I start to, pull back on the aggressiveness in the market, start to look more and more for positions to short. But I also use it, for example, when we're having this interview, we're late August of 2018. Back in December, the market hit a high. And what markets do, they go long-term trend to a trading range, back to the long-term trend, or long-term trend, reverse trend. When that market comes to the resting portion or the end of the long-term trend, it will normally move sideways for some period of time. For the last 7 months, we have been in a sideways market or a rotational trading environment. It was just today, on the 27th of August 2018, that the market broke clearly to new high grounds. So now we went from long-term trend to a trading range or balance, and then broke to the upside. Now, whether we continue or not, it's too early to tell. But when that happens, I'm not going to fight that trend. I think the market one time framed higher for, I want to say 11 or 12 months. And by one time framing, that means that the next month did not take out the low of the previous month, et cetera, et cetera. And that went on for, like I say, 11 or 12, 13 months. You don't fight that. You just stay with that trend. You may do some counter, trend trades in there, but you're aware that they're just short trading moves. They're not anything lasting. So, you need to be aware of everything in the market. Once we move to where the market moves sideways for 7, 8 months, whatever it is in here, then you have a whole different style of trading. You're looking for shorter term trades, shorter duration, and you're not in a trend, different market. So those are the things that I meld into my thinking and my recognition about trading.
So from hearing you speak, you're pretty much all discretion, no systematic approach.
That is correct.
Gotcha. So let's talk about that a little bit. Let's talk about preparation. Take us through what you're doing, whether it's the morning before or the night before you begin to trade.
That's another very good question. Most of the folks that I deal with and that I work with are very short-term traders. The shorter we are as traders, as the day ends, the more narrow our focus has normally become. And that can be a real trap. So as soon as the day is over, I go from that shorter period of time, more than likely the shortest period of time, and I immediately pull up a monthly bar chart. I pull up the monthly bar chart, which forces me to go from this very short-term thinking to a much longer time frame view of the market. So I review the monthly bar chart. I then move down to the weekly. After the weekly, I move to the daily, and I'm looking for trends within trends. I'm looking for trading ranges. I'm looking for balance areas. I then move down, after I go through the dailies, I then move back down to the more recent market profiles to get a better view of the market and what I think the short-term opportunities may be, or where I think the short-term risk may be the highest or the lowest.
So take us through.
Let me add one thing. Then I think it's important, when that is done, I write at least 3 potential scenarios that I see for the coming session. And the reason for that is it is so easy for us to get opinionated. You can't trade very long and not realize is that there's times you'll bring your own personal biases into the market, and they may not be objective. They may be based on some other prejudice, or you lost a trade, or you just don't believe. So I write three scenarios. One is the market, stays very close and doesn't rotate much the following day. One, it trends upward, and two, it trends downward for those particular days. And I want to be able to argue those three positions to do the best job it can to get me in an objective state. Then I take that information and I get up the following morning. And one of the things that I've discovered is that overnight trade has become more and more important. And I find that about 65% of the time, and that's not a really scientific study, it's more anecdotal than anything else, but about 65% of the time, if overnight inventory is up overnight, there will be a counter auction or a fade of that inventory early in the morning. If it is down, then the chances are that we're going to get a little rally early in the morning. Now, if the overnight inventory is higher and the market doesn't care and we don't get that counter auction, then that's another indication that the market's going to be pretty strong today. So I go through these. One of the most misleading days that traps short-term traders the most. Let's say, for example, the market is up, and let's say all indicators are up except the overnight inventory is long. You get a fairly fierce counter auction to that long overnight inventory. And of course, then you see prices going down, and traders get trapped by that price rather than understanding that that was just a correction to overnight inventory. Overnight inventory usually held by weaker hands traders. They are more easily scared in or out of positions. So that's when I'm talking about nuances earlier. That's one of the nuances that you have to bring into the equation. So that completes my preparation.
I want to talk about entries and exits next, but quickly, what market or markets are you trading?
Well, all I trade right now is the ES. As I said, over the years, I've traded almost every market. I've traded beans, I've traded crude oil, I've traded gold, copper, silver. But as I get older, I'm 78 now. As I got older and I'm enjoying the teaching portion, I'm focusing just on the ES, E-mini, S&P. And the reason for that is it's, from what I can see, it's the most heavily followed market out there. And of course, they add in the things that spin off of that are traded in the equities market.
All right, let's talk about entries. Do you scale in? Are you in all at once? Are you always trading the same contract size, or do you trade different contract size based on situations?
No, I will normally trade in. I'm not a big trader. As I've gotten older and I've seen a lot of people, take some fairly significant losses in trading if you do it long enough. I'm respectful of the market and what the market can do. So I will often scale in and scale out. But most of my trading today is taking only short-term trading. Occasionally I'll take something home overnight, but most of my trading today is day trading. I find I sleep a lot better that way. But what I don't have, and what frustrates a lot of people that take some of our educational courses, is they want to know, well, exactly where do I get in and exactly where do I put my stop? And I just think those are the wrong questions. If there were exact places to get in and exact places to get out, they would have been computerized a long time ago, and they would be arbitraged away very quickly, which is another reason that, I don't really believe in systematic trading. If anybody had a system that really worked, somebody with substantial money or a hedge fund would have bought it up and used it themselves and not made it available for anybody else a long time ago. So my trading is usually scale in, scale out, mostly day trading, but no exact entry and no exact exit. And that is very frustrating to a lot of people. That's how they want the market to work. I just don't think it works that way.
So my next question was going to be how you exit trades, and you already answered it in the last question. You said that you scale in and then you scale out. So for the next question, can you just take us through a recent trade or a trade example of the reasons you scaled in and scaled out of a trade?
Yeah, not always. Today is, as I said earlier, it's August 27th, 2018. The market gapped higher today. So as we said, normally you want to go with those gaps. You don't want to fade those gaps. If there is a good buying opportunity, when a market gaps higher, for example, the market will usually attempt an early pullback. On that early pullback, the tempo will slow, and tempo's like speed. It gets kind of slow. The volume starts to dry up, and that's usually a buying opportunity to go with that breakout. And at that point in time, those are the times that I like to look at a market entry. And then as the market moves higher, and today as it moved higher, it didn't elongate out. It truncated. And once it truncated out, then you're saying, okay, the opportunity here is very limited. At that point in time, you just step aside. Too many people try and force a trade in there. And quite honestly, if you and I hadn't had this interview scheduled for this afternoon, I'd have been out for doing other things and riding my bike or exercising, hours ago, because it was just one of those markets. There was nothing there. But that's what you have to accept. Too many times people want to make something out of the market that it doesn't offer. So that would have been today. I mean, those are the decisions you're always making. Sometimes, you'll get on a trade like that and you say, wow, it really starts to pick up some speed and you get some momentum on the upside. Well, you may add to your trade at that point in time. So it's never done the same way twice, because the context is always changing. And that's one of the things that makes it so hard for traders to get their arms around trading. It's understanding the context surrounding every situation. Is the context such that the odds are pretty good we're seeing new business? Or is the context more likely that we're seeing old business? Always have to be focused on the context.
So you're very discretionary, and like you just mentioned, nothing is done the same way twice. And you talked about the context. So I'm curious, do you have a trading diary? And if so, what are some of the things that you're putting in your diary?
I want to say as a smart aleck, that's none of your business. What I put in the diary is sometimes embarrassing. The mistakes that I continue to make are mostly based on my own personality. You fought a trade. You didn't take your loss as you should have taken it. You were too hesitant to get in because you were afraid. And so the entries I make in my diary have to do with what I see as personal traits that I exhibited that day that weren't the most flattering. And we do, we think we should grow out of this, and we never quite do. The simple example I've given over the years, I've got a very athletic lower leg, and it's hard for me to buy a dress sock, when I used to work in dress clothes, where I could keep the calf on the sock up on my calf. Oh, the only thing I found that worked for a long time was gold toes, but they weren't tremendously cheap. And every now and then I'd see a deal. I'd buy the sock with a deal, and lo and behold, the first day it'd be down around my ankle. Well, maybe I'd go 6 months before I made that mistake again. And I found out, what? I still made the mistake, but the time between mistakes was just longer and longer. And it's amazing that we never quite get it right all the time. And that's what I'm continually fighting, is the self-understanding.
So in your diary, you're putting a lot of things about psychology of trading.
The psychology of trading, but they're more my own psychology than they are the psychology of trading.
Yeah. And you mentioned self-understanding, because you and I have had prior conversations, and you talk a lot about this self-understanding versus market understanding. Explain to everybody what you mean by that.
Well, I can teach the market understanding fairly well. I mean, I've been doing that for a long time. I'm not particularly good at teaching the self-understanding because I haven't totally mastered it myself. And every one of us is so very different that it's really hard. Do you self-understand me? Are you too afraid to enter a trade that you should enter into? If, for example, when I talk about a market gaps higher, well, today it was, probably 10, 12, I don't remember, 10, 12, 13 handles higher. And sometimes people will freeze. I can't buy it, when it's that much higher. And very often that will be the best opportunity because the market is out of balance. It's showing its hand. It's going higher. But yet you freeze because you muster up this fear in your mind that's just too much risk to take. And very often it's far less risk than your mind imagines because it's got some momentum to the upside. And it takes some time to get yourself to the point where you understand that there is less risk in that trade than there is in buying something that, is down or not up nearly as much. Because when it's up that much, the trade is on its way. And there's a lot more to run. Another thing that people do, and I did it early on, I've cured myself of this one, is people manage their trades too tight. They build it up in their mind that they're being prudent and they're taking less risk by keeping their stops really tight. And that's probably the worst strategy anybody can ever take. You just get stopped out. You've got the spread between the bid and the offer. You've got commissions. But psychologically, on one side, you think you're doing just the right thing. Another thing is you get on a good trade and the trade moves up to the upside and you're going to put your stop at break even. You feel very good psychologically because, boy, I can't lose on this trade. But that's just, there's no reason for putting the stop at break even other than the fact it gives you psychological satisfaction. And that is a very poor reason to make a trade. We need to understand that, you need to base your stop on something else rather than just, this feels right to me.
You've mentioned to me in the past, first of all, I agree with that. I think that a stop should be where the trade is no longer valid, where the trade is now wrong. I mean, people have asked me many a times, Anthony, how do you know where to place your stops? I'm like, well, depending on the scenario or situation that I'm looking at, where that trade no longer makes sense to me, that's where my stop goes. And I just trade my size accordingly to the distance of how far that stop would be. So I'm in complete agreement with you on that. And something you've mentioned to me is you believe very strongly in immersion training. Talk to us about that.
I say no two trades are the same. For example, a market going up on higher volume is a much more confident market than a market going up on lower volume. If we do our training in immersion, we can talk them through it. I call it tell me a story. If a market's going up and I'm narrating that market on the upside, I will show them how to look at volume, how to look at structure, and how to determine if that market looks like it's gaining confidence as it goes up. And you can only do that. It's not at a particular price. It's not at a technical level. It's watching the market go. And you only learn that if you're immersed in the market as it goes, and you can talk about it and give people experience. It's a lot of times I forget the name of what that training language for a foreign language was for a long time.
Rosetta Stone.
Yes, Rosetta Stone. All their training was immersion training. And that was around for a long time. I don't see the name anymore. I don't know if they've been bought or not. But I took some courses that way, and I found out that was just far better to me than learning it in a very safe structure, which tends to be when we tend to do the training without immersion type, we tend to make it linear. Trading is everything but linear. As much as we might like it to be that way, it doesn't work that way. So each situation is slightly different. It is that recognizing that difference in the particular situation that gives you an edge over everybody else. And I just think it's the only way that I can see that allows you to learn and understand that context is far more important than is price.
I love hearing you say no two trades are the same. And a lot of from what I'm hearing from you today is you say no two traders are the same. I believe in that.
I agree.
Yeah. This was great stuff today, Jim. We're not done yet. I have some rapid fire questions for you if you're ready for those.
Sure.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. Jim, first question. What trader has influenced your life the most and why?
I don't think it's a particular trader that has influenced me the most. As I said earlier, I think the trader that was the worst advice was the trader that told me professionals short the market. So I think that was the worst advice I've ever gotten. And I learned more from doing myself. I learned more from the mistakes I've made over the years than I do from anybody else.
What was one of the hardest things that you had to overcome in trading?
Still have to overcome, and that's myself. I have this tendency to want to fade price. I know that's wrong. I can talk about it forever here, but I still have that tendency, and I have to constantly guard against that. It's just something that's, natural to me.
How has your trading process evolved over the years?
It's really changed. As I said early on, I had a membership on both the Chicago Board of Trade and the Chicago Board Options Exchange. Down there, when you're on the floor, as you well know, and I wasn't there that long, you're looking for relatively very tight markets. Well, not very tight markets, but you've got the bid and the offer as to your advantage. Once you trade from off the floor, that goes away. You're no longer buying on the bid, you're buying on the offer. So that was the first change when I realized that advantage wasn't there. And then I've gone from using technical analysis to backing totally away from technical analysis. And I finally evolved to the point where I started relying 100% on myself and doing my own analysis of the market, as I explained earlier, how I prepare for each day.
What is one attribute that you believe every trader must have?
Mental flexibility. So many times we defeat ourselves because we don't have that mental flexibility. And the shorter term that you are as a trader, the more important that mental flexibility is. As you know, you can get a piece of news that comes out of left field, and you have to be able to make that adjustment. If you can't make that adjustment, you're not going to make it as a short-term trader.
Now, Jim, I know you've written a couple of books. So what's your favorite book about trading that's not one of your books?
It's more an author than it is a book. Brett Steenbarger, the trading psychologist, both to individuals and to hedge funds, I guess his best book, in my opinion, was Enhancing Trader Performance. When I first wrote Mind Over Markets, the first book, Brett sent me back about a 40-page response to the book. it ended up within a few months that he invited me out to his home in upstate New York. And at that point in time, I got really involved in understanding more and more about the individual's play in the market. So I read everything Brett writes. Now, I'm not like anybody else, I'm not in 100% agreement. But I think it's helped me more than anything else to address some of the self-understanding issues.
If you can give a piece of advice to the younger you, what would it be?
It would be keep your mind open. Don't take any one thing as the gospel. There's nothing that's perfect in the market. And you have to have, as I said earlier, mental flexibility if you're going to survive as a short-term trader.
You told us at the beginning of this segment what your worst piece of advice that was given to you was. Now, what's the best piece of advice that you've received about trading?
I think the best piece of advice really came from, one of the hedge fund managers years ago that talked about just the importance of being intellectually independent.
Last question for today, Jim. What's your favorite thing to do when you're not trading?
I love to fish.
Fisherman, huh?
I've now gotten hooked on steelhead, and I do a lot of fishing in the Washington Peninsula.
I had steelhead for the first time this year, actually, and I loved it.
Can I leave you with a steelhead story?
Sure.
I was fishing last year. I had a guide, and this one boat kind of pushed its way by us, which was kind of rude on a relatively narrow river. I saw them lose a fish, and we were a little bit behind, and I hooked on, I think it was the same fish. You can't be sure, but we're pretty sure, and it had a lure still hooked into it. It was a 22-pound steelhead, and that was just one wonderful experience.
Jim, where could people find you on Twitter, and give us a website to check out?
Jim at jimdaltontrading.com. And the only thing I do on Twitter, usually every morning, I will put up a tweet in the morning, just for anybody that wants to take a look at where we are and what we're thinking. I don't do anything else on any other social media.
Jim, what could I say? It was an honor having you on the show. Thank you so much for coming on Futures Radio Show and speaking with me today.
Anthony, thank you for the opportunity.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.